All right, let's jump straight into this explainer. Today, we're putting on our analyst hats and pitching to a value investment committee. We're going to take the legendary Warren Buffett value investing framework, combine it with some really rigorous quantitative valuation, and apply it all to a super fascinating player in the automotive retail space. We're talking about Asbury Automotive Group, ticker symbol ABG. We are looking strictly at the numbers, the filings, and the raw fundamentals to answer one simple question. Is this a wonderful business trading at a fair price? To figure that out, we are going to break this down using a classic 5-step framework: business and moat, deep financial analysis, valuation models, margin of safety, and finally, the verdict.
Step 1. Business and moat. Does this company actually have a durable competitive advantage?
So what are we actually looking at here? Asbury is an absolute beast in the U.S. auto retail space. They operate 161 new vehicle dealerships representing 36 different domestic and foreign brands. Now, obviously, they sell cars, both new and used, but here's the real kicker. They offer highly profitable parts and service, as well as finance and insurance products. That is where the real magic happens. And management? They aren't just sitting around. They've set an incredibly ambitious target to hit $30 billion in revenue by 2030, which they plan to do through a mix of organic growth and aggressive acquisitions.
Now, do they have a moat? Absolutely, and this quote perfectly illustrates it. When we assess an economic moat, we are looking for real structural advantages. As Fitch Ratings points out in the filings, this industry has incredibly high barriers to entry, mostly because of protected franchise agreements that are heavily regulated at the state and federal levels. Basically, you can't just wake up one day and decide to open a Mercedes dealership right next door to Asbury's. Combine that regulatory shield with the massive upfront capital required just to build a store and fund the inventory, and new competitors are effectively locked out. We confidently rate this a wide moat.
So let's run this through the Buffett moat checklist. Is it an understandable business? Yeah, selling and fixing cars is pretty straightforward. Durable competitive advantage? Wide, thanks to those franchise protections we just talked about. Do they generate consistent high returns on equity? Yes, they do. And here is their secret weapon. Their parts and service segment is highly recurring and drives a whopping 49% of their gross profit. Finance and insurance drives another 24%. That gives their earnings incredible stability. Lastly, is management shareholder friendly? Well, the filings show a massive $500 million share repurchase authorization. So yes, they are very shareholder friendly. All right, section 2, deep financial analysis. Do the hard numbers actually back up this wide moat? Let's look at the numbers, because the income statement trends over the past 5 years are just explosive. Revenue skyrocketed from $7.1 billion in 2020 all the way to $18 billion in 2025. That is a 152% increase, which translates to a 17% compound annual growth rate. Earnings per share totally followed suit, jumping from $12.90 to $28.10. Management is clearly allocating capital well to generate highly predictable owner earnings, which, as a reminder, we calculate as net income plus depreciation and amortization minus maintenance capex. But hold on, every investment has risks, and we need to pivot and talk about the elephant in the room, 2.7%. That is Asbury's trailing net profit margin. Look, auto retail is notoriously thin when it comes to margins. So while they are pulling in billions in top-line revenue, they're keeping less than 3 cents on every dollar. The big debate among analysts right now is whether Asbury can successfully expand that margin to 3.1% over the next few years. If they can pull that off, the bottom line is going to absolutely explode. But if margins compress, that's our biggest downside risk factor. Now, what about the balance sheet? Especially in a higher interest rate environment, debt is a big deal. Total debt sits at $3.5 billion, while their accessible liquidity is $1.15 billion. At first glance, that debt load looks a bit heavy, right? But if you dig into the footnotes in the filings, there's a huge relief point. $2.25 billion of that debt is in unsecured notes that don't even mature until between 2028 and 2032. That gives them a really long, safe runway. In fact, Fitch recently revised their outlook to positive, which completely validates the strength of their balance sheet. Cash flow is where things get really fun. They generated roughly $1 billion in adjusted EBITDA in 2025. And Q1 of 2026 kicked off with a huge basic EPS surge of $9.88 for just that quarter alone. Management's capital allocation strategy is super dynamic. They're doing aggressive M&A, like scooping up the Jim Koons Automotive Group, but at the same time, they just sold off 13 underperforming stores. They are aggressively pruning the tree to prioritize long-term efficiency, boost their return on invested capital, and maximize free cash flow conversion. Moving on to part 3, valuation models.
We know it's a solid business, but what is the actual intrinsic value of a single share?
Let's start by running the classic Graham intrinsic value formula. First up, our trailing 12-month EPS is $28.30. Next, for expected growth, let's play it safe and cut their historical 14% growth rate right in half, down to 7%. Now, the filings don't explicitly give us the current AAA corporate bond yield, so we have to assume a standard 5% yield to complete the math. When you plug all of that into the formula, it spits out an intrinsic value of roughly $560 per share. Next up, the discounted cash flow, or DCF analysis. Again, since the filings don't hand us their internal cost of equity or debt on a silver platter, we have to assume a weighted average cost of capital, a WACC, of about 9% for our base case. Even if we assume a super conservative terminal growth rate of just 3%, which is basically just pacing inflation, the DCF still points to a value significantly higher than where it's trading today. And hey, if their new tech rollouts actually succeed and boost efficiency in our optimistic scenario, those cash flows look even more incredible. And here is the kicker, folks. Before the market open, Asbury was trading at $195.78. You divide that by our trailing EPS of $28.30, and you get a price-to-earnings multiple of under 7. Historically speaking, that is crazy cheap. If you run a reverse DCF calculation, a PE of 6.9 implies that the market is pricing in practically zero future growth, zero. The market is literally treating this like a dying business, totally ignoring their historical 14% growth rate and that massive $30 billion revenue target. Step 4, margin of safety. Warren Buffett's #1 rule is never lose money, and this is exactly how we protect our downside. Just look at this visual disconnect. It's staggering. You've got the current stock price way down here at $195 and our highly conservative Graham intrinsic value estimate way up around $560. That market price currently gives us well over a 30% margin of safety against our base case intrinsic value. Mathematically, it's actually way higher than that. Listen, even if our growth assumptions are completely wrong and this company just flatlines and stagnates, the current buy price is so deeply discounted that you have this massive cushion built right in. This is literally the exact kind of asymmetric risk-to-reward setup that value investors dream about. Finally, step 5, the final investment verdict. What are we telling the committee? It's a definitive buy, no question. Would Warren Buffett likely buy this company at today's price? Everything in the data overwhelmingly points to yes. So here is our wrap-up thesis for the investment committee. Asbury Automotive Group is undeniably a wonderful business that is trading at a heavily discounted price. They've got a wide economic moat protected by strict franchise laws and huge capital barriers. They are churning out strong, predictable owner earnings, completely anchored by those highly profitable parts, service, and F&I divisions. Management has proven they know how to allocate capital to drive massive EPS growth, and yet somehow the market is handing us this cash-generating machine at a PE multiple of less than 7, giving us a tremendous margin of safety. I'll leave you with this final thought to chew on. The real catalyst for Asbury moving forward isn't just selling more cars, it's all about efficiency. Will their ongoing divestitures and major software transitions successfully expand that razor-thin 2.7% profit margin? Because if they do, the intrinsic value isn't just going to hold steady, it's going to skyrocket. It is going to be a fascinating dynamic to watch play out over the next few quarters. Thanks so much for joining me on this deep dive. Keep your eyes on those filings and keep learning.